When you buy a stock, you often might want to ask yourself, well, how long do I keep it? Do I sell it if it goes up a couple of dollars? Well, what does Warren Buffett, arguably the most successful investor of all our time, do? He says our favorite holding period is forever. He also says, if you're not going to hold a stock for 10 years, don't even hold it for 10 minutes. Well, look, what about not just stocks, but treasuries? They've been a favorite for long-term investing as they weather volatility and provide consistent income. Jack McIntyre is a portfolio manager for Brandywine Global. He runs fixed income and related strategies. Here to talk about long-term investing, Jack. And it's different, isn't it, when you're doing long-term investing for stocks versus fixed income? How do you do it?
Yeah, no, I agree. It is certainly different. You have to have a little bit of a different time frame than you would have for equities. I think fixed income, it tends to be driven a little bit more sort of by business cycle influences. But having said that, though, there are certainly some secular influences that your viewers need to keep in mind when it comes to having some core position in U.S. Treasuries, despite nominal yields. The yields that they report in the paper might be low, but Treasuries serve a lot of different roles in overall asset allocation.
Well, you know, it depends on your time horizon always, and I understand that. But you say, like what everyone else hates when it comes to bonds.
Yes.
Stick to your asset allocation plan. Well, how much of one's long-term portfolio would you allocate, Jack, to fixed income?
So this one, it's hard to do a cookie-cutter approach. I mean, it certainly is going to be a function of how much savings, your age, where you are in proximity to retirement. My point being is that you've got to, even though you don't like Treasuries, yields seem to be low, you need to allocate some of your capital towards Treasuries. They serve a different role. It's
well, there are a whole bunch, aren't there? I mean,
so
there's 5-year, 10-year, 2-year, 30 years.
Oh, yeah.
So
yeah.
which part of the yield curve do you really like right now?
So I like the long end of the curve, and that's driven more by inflation expectations. You know, and I'm not going to say you're not going to become a billionaire owning Treasuries right now. It's just that
3% on the 30-year.
So, yeah, it's just, you know, hey, if something negative happens, we go to a risk-off environment. Well, those Treasuries are going to act as a little bit of a cushion to your other parts of your portfolio.
What if you want something that is in fixed income but looks more perhaps like a stock fund, an ETF, for example? Do you have ones that people should categorize and go for?
So I think here is that we need to think a little bit outside the box when it comes to fixed income investing. We need to look at funds that have what I call a fully unconstrained sort of mandate, where they can go in, they can be long bonds, they can be short bonds. I like global because I actually think the U.S. dollar has sort of topped here for the next several years. So I like funds that actually have the ability to be able to buy foreign currencies, but still have the flexibility to maybe even short some foreign currencies. The point is, we've got to think about being able to go anywhere in terms of fixed income. Look at credit, look at global bonds, look at EM, which is certainly probably the favorite part of our universe right now, despite it's rallied a lot. But keep in mind, it's lagged since 2011. So, you know, we view this as sort of a multi-year sort of process for emerging markets to do well.
There you go, long-term investing. Jack, I have to ask this because I get so many Twitter questions on this particular subject, and that is that, look, the FDIC data has just revealed that deposits at U.S. banks have jumped 65% over the past decade, which in essence means people are too scared of the stock market at the moment. So now it stands at $12.9 trillion sitting in deposits at U.S. banks. But we're talking about paltry returns. When do you think banks will start to increase their deposit rates? That's what many of our viewers are waiting for.
Yeah, you can blame it on the Fed. We are still in this environment where they are punishing savers by keeping rates extremely low. You know, what we're going to see is as equities continue to rally, make new highs, some of that money is going to be put to work, but, you know, the timing might not necessarily be good. But my point, there's other ways. Well, no, I think the Fed is going to go slow. I think they've told us the roadmap they're going to go 2 times this year. I suspect that they actually might continue to go even slower. At some point, they'll talk about reducing their balance sheet, but that's a 28 sort of issue. I just think, if you're looking for yield income to surpass what you're earning on that measly bank deposit, there are certainly ways to do that without taking on a lot of credit risk.
We're going to put all of your suggestions on our Facebook page, facebook.com/Liz Claman. Jack, it's good to see you. Thank you for guiding our viewers.